Why are global investors, both retail and institutional, rushing into bond funds like never before? In just 1 week, over $17.9 billion flowed into global bond funds. That is not just a big number, it is a signal. A signal that the bond market is trying to tell us something deeper about inflation, growth expectations, and the direction of monetary policy. In this video, we break down why this is happening, what it reveals about the global economic outlook, and how bond yields, prices, and capital flows are all interconnected. If you care about truly understanding macroeconomic shifts and the inner workings of the bond market, not just surface-level headlines, hit that subscribe button right now. This is a full concept deep dive packed with insight and clarity you will not find in typical summaries. Let us get started. A $17.9 billion inflow in a single week. That is one of the largest ever recorded in the history of bond funds. But the real question is, why now? The answer lies in a mix of powerful macroeconomic turning points. Disinflation is gaining momentum. Central banks are signaling rate cuts. Global growth is softening, and geopolitical risks are rising. In simple terms, we are entering a phase of transition, from policy tightening to easing, from fear of yield to the opportunity of yield. And that is exactly where the bond market starts to shine. Let us go back to the basics, because this is where the heart of the shift lies. When bond yields fall, bond prices rise. That inverse relationship is the foundation of every bond strategy. So when investors expect rate cuts, they start buying bonds before the cuts actually happen. Why? Because they want to lock in higher yields now and ride the wave of price appreciation as yields decline. And that is exactly what we are seeing today. Investors are not chasing short-term gains. They are positioning for a major regime shift, anticipating that the yields available today will not be around 6 months from now. It is a classic duration trade, but with a twist. While long-duration bond funds, especially government and investment-grade corporates, are attracting institutional flows looking to lock in yields and benefit from price gains, short-duration funds are also seeing strong demand from those who want yield but with lower exposure to interest rate risk. In the United States, the Federal Reserve has not cut rates yet, but its tone has clearly shifted. Markets now expect up to 2 rate cuts by the end of the year, driven by falling inflation and weaker job data. 10-year Treasury yields have come down from their peak, but they still appear attractive, especially when compared to where rates are likely headed. That gives bonds a unique mix of safety and potential gains from rising prices. Over in Europe, the European Central Bank has already begun cutting rates. And many emerging market central banks, particularly in Latin America, acted earlier and are now well ahead in the easing cycle. The message from all this is clear. The global tightening phase is behind us. Rate cuts have either already begun or are just around the corner. Let's look at what's really driving this flood of money into bonds. When stock markets appear expensive, economic growth shows signs of slowing, and volatility increases, investors naturally start shifting towards safer assets. But the recent bond inflows are about more than just safety. They're also about timing and opportunity. This is where fear and the fear of missing out come together. There's fear of a recession, fear that inflation might return, and fear of an equity correction after a long bull run. At the same time, there's FOMO, the fear of missing out on price gains as bond yields fall and prices rise. That's why we're seeing strong inflows from both retail and institutional investors. According to recent data from Morningstar, major United States bond exchange traded funds such as BND and AGG are pulling in billions of dollars each week. These inflows are not just from passive investors. They include wealth managers, family offices, and large institutions who want to lock in current yields before the Federal Reserve begins cutting interest rates. Significant capital is also flowing into United States Treasuries, mortgage-backed securities, and high-quality corporate bonds. The idea is simple: earn solid income now and benefit from price appreciation later. In India, the story is equally strong. Since India's official inclusion in JP Morgan's Global Bond Index began in June 2024, foreign investor participation in government securities has accelerated sharply. As of July 2025, foreign holdings of Indian bonds under the fully accessible route have crossed 3 trillion Indian rupees, in line with early projections of $20 to $25 billion in inflows. This reflects long-term confidence in India's bond market and macroeconomic stability. So what do record bond fund inflows really tell us? They signal a regime change in investor expectations, a shift from inflation anxiety to growth caution, from chasing risk to locking in yield. They tell us that the bond market is not merely reacting to central banks, it is anticipating them. And most importantly, they remind us that bonds are not just defensive instruments, they are strategic vehicles during times of macroeconomic transition. The capital rotation we are witnessing today is a macro narrative, written not in headlines but in yields, spreads, and capital flows. As Howard Marks puts it simply, sometimes it's time to take risks. Other times, it's better to play it safe. The best investors know the difference. Right now, global markets are signaling a shift. Understanding the bond market is no longer optional, it is essential. If this breakdown helped you see the deeper logic behind the headlines, hit like, subscribe, and turn on notifications. This channel is here to demystify finance, one deep dive at a time. Stay sharp, stay curious. See you in the next one.